Yeah, it's a good point to make. When input costs go down on the mines, especially energy, it tends to boost the difference between their costs, all-in sustaining costs, and what they're making on an ounce of gold. So as energy becomes relatively cheaper, it's really a big boon, especially for these gold mine companies that are running their sites off of diesel or have a lot of trucking expense as well. We're going to go over charts and talk about what's going on in the marketplace. And we have Kevin Wadsworth of Northstar Bad Charts. You guys that follow him on Twitter and on the Kinesis channel live from the vault know that they put out extremely high quality content along with his partner that we always enjoy. And the charts are stunning and we love them because they're basically chock full of information. We're going to have him walk through some of the latest that he sees on his end. We've also got Danny from Capital Cosm. We're turning the tables around with you, Danny, and you're going to come on and be our guest. Wanda, thank you for having me on your program, but you're growing so much and you've got great opinions on what's going on. So we wanted to bring you on and get your thoughts as well. Welcome both of you to the program.
Yeah, it's a pleasure, Rob.
Cheers, Rob. Thanks for
absolutely. I've been wanting to do this for a while. I love doing the roundtable format, but also kind of getting into some charts and some technical analysis. Before we do that, I kind of wanted to set the stage and just get your general opinions for a couple of minutes on what's going on in the world. And we've seen a lot. We've seen, are we going to tariff gold into the US? Are we not going to tariff gold? We've seen all sorts of stuff going on, the jawboning back and forth of the administration with geopolitical. All of that, Danny, seems to be driving. I'm actually going to start with you. All of that seems to be driving this sort of geopolitical narrative. What you interview a lot of guests and you're looking at this from your view. What do you think is like the major drivers right now going on in the world financially? What are you focusing on?
Yeah, I think the major drivers are, in fact, much more long-term and much more embedded in cycles as opposed to one-off news events like whether or not we're going to tariff gold. As you alluded to, there was an announcement a couple of weeks ago that we were going to tariff gold, and there was a clarification a few days later, and it sent the price up and down. And in my view, from what I've gathered, is it's not really the best way to look at it. The best way to look at it is in a way where, like Kevin and Patrick look at it, is, you guys do this as well, is you look at this thing in terms of cycles. And where we are in the cycle, I mean, there's going to be ups and downs. Nothing goes up in a straight line, but we are at a point where we are starting to see a bid on gold relative to everything else. And that's significant because it's sending a signal through the market that you're heading towards a reset of some sorts, a financial reset, a currency reset. Be it what it may, it's a significant reset. And us as investors, it kind of pushes us to not just try to time the small ups and downs, the short-term waves, but you really want to see it at the table when it comes to the longer-term cycle, the longer-term waves. And what I mean by that is a massive capital rotation when it comes to natural resources, gold, silver. You see this happening across, and I know, Kevin, you've got some charts. I've got some charts as well that illustrate this too. Looking at who's buying the gold, who's buying the silver, and how can we connect this to times in the past. And even from a broader perspective, you have like things like fourth turnings that we're currently under. And that's kind of like an 80-year cycle where you see a reset in the global world order. And when you see a reset of that magnitude, it also precludes a financial reset. So we're kind of at the intersection point of all of these big cycles happening all at once. You have the fourth turning cycle. You have these this AI boom that's heavily resource intensive. You're in the middle of all these wars over resources and a bunch of other things, and wars are inflationary by nature. There's not a single war that's deflationary. So all of these signals signal a inflationary time period that we're heading in. And I think it behooves us not to want to at least have some sort of seat at the table and ride the wave up. Whether we're early or not, we can debate that, but it's as my good friend Rick Rule would always say, there's a difference between imminent and inevitable. So I think that's the question that's on the minds of many. But we'll discuss this, I presume, as the podcast expands. So that's what
Yeah,
I
awesome,
see
Kevin. I
going
think
out
that might
there.
have teed you up for capital rotation. You want to jump into that, or let us know what your thoughts are in relation to what Danny said around cycles. You're really big on cycles, and he was talking about longer term cycles where that may lead to an impact on the financial markets and the gold and silver prices. What is your view on that in terms of where are we in the gold cycle? Are we ready to launch? Are we in the middle? Kind of what's your view on that?
Okay, yeah, sure. I mean, that phrase capital rotation, it's worth defining for people watching and listening to this, what capital rotation means in this context, because it can be used in a variety of contexts. But certainly the way that I would use that phrase in this particular context is with gold and the stock market. You have to choose a couple of opposing sectors, major opposing sectors that react in kind of opposite ways during the economic cycle. So I'm talking about risk on and risk off periods of time in history. So during those risk on periods, stock markets and risk on sectors will do extremely well, and they will outperform precious metals. You know, the pet rock, gold, just sits there and does nothing. Well, the stock market massively outperforms that during those risk on cycles. But there are periods in history, and this will be the fourth one in 100 years, where gold very, very significantly outperforms the stock markets. So, you know, you can go back to 1930 when the first signal in this series happened in the last 100 years. Stock markets pretty much collapsed and gold massively outperformed the stock markets, gold, silver, commodities, energy, that kind of thing. The same thing happened in the 1970s, of course, when gold massively outperformed the stock markets. Stock markets went nowhere for over a decade in a series of ever more troublesome sort of declines. And each recovery was then sold into another decline, so the stock market went nowhere, and gold really took advantage of that. Of course, gold had just been, had the advantage of being, the dollar, the gold standard had just been removed, if you like, the Bretton Woods Agreement. So gold was able to free float in the market, and it shot up from $35 to $850 or whatever it was. So that partly explains that. But that particular cycle was perfectly valid. It may just be that gold somewhat overshot where it might otherwise have done. But then we had another signal in the early 2000s, another capital rotation event. So the same sort of process happened where gold really took over and had a decade, just over a decade, where it outperformed stock markets enormously by hundreds and hundreds of percent. So, and also it's worth pointing out, of course, that the stock markets and, for example, the Dow Jones, they peaked versus gold 25 years ago. So, you know, you could actually view what's been going on over the last few years in that ratio between stock markets and gold. You could view it as a bear market rally, really. The stock market has rallied versus gold, but has got nowhere near its previous all-time highs. So when you look at it on a technical chart, it just looks very much like a bear market rally rolling over to continue. So, we're early in that process. Yes, gold has pretty much doubled from $1,800 to where it is now. And the process is still quite young, and we can see that a number of ways. I mean, look at the miners; they're only just the precious metals miners are only just starting to break out versus the stock market. So, very early in the process.
Right, very interesting. What are your thoughts on that, Danny?
Yeah, it's interesting. Kevin brought up the miners because I also have a chart that I think is very interesting as well, because when you think of the miners, let's think of their business model, right? Their business model is, well, they benefit off higher gold prices, obviously, but then they also benefit off lower input costs, i.e. energy costs. And what have we been seeing the last couple of years, since about 2022, since oil topped? And that's been a declining cost of energy. And so when you look at something like, let me pull it up here, like the Huey, which is a gold bugs index. This is a gold miners index, much like GDX is, but this has a little bit of a longer tail or longer time frame we can look at. When you look at something like the Huey, this goes all the way back to 1997. You'll see we've been, making some pretty big moves when it comes to the mining stocks. Now, what's interesting is if you juxtapose a ratio, and this ratio is gold relative to oil. So gold divided by oil. And so the way this ratio works, gold's in your numerator, oil's in your denominator. This ratio goes up when gold outperforms oil, and it goes down when oil outperforms gold. So what have we been seeing the last couple of years? We've been seeing gold outperform oil, which would tell us, which is indicative of higher margins on the part of these gold mining companies. And what you'll notice is you've got the candlesticks here denoting the mining index. And then in orange, you've got the gold to oil ratio. And for the most part, you can see there's a fairly strong correlation between the two. In fact, this orange line tends to move. There's a little bit of a lead time from when this orange line moves to when the mining stocks move, which kind of makes sense because your mining stocks need that, need for that ratio to play out into the market for it to be reflected in their earnings. And so what we're seeing now is a pretty strong track of gold to oil moving in tandem with the mining stocks. Now, we've seen some disparities in the past, but oftentimes they mean correct very violently as well. But here we are. We're seeing mining stocks starting to get a bid. And when you ask yourself, who is buying the mining stocks? Well, let's take a look at GDX.
Yeah, it's a good point to make. When input costs go down on the mines, especially energy, it tends to boost the difference between their costs, all-in sustaining costs, and what they're making on an ounce of gold. So as energy becomes relatively cheaper, it's really a big boon, especially for these gold mine companies that are running their sites off of diesel or have a lot of trucking expense as well.
Mm-hmm. And so now the question becomes, who's buying these mining stocks? So what we're looking at here, this is a chart of GDX. You can't really see the black line because it's behind the it's behind the green bars. But the black line is effectively your GDX share price, and the green bars are it's the volume of institutional ownership. It's the volume of shares owned by institutional owners, i.e. hedge funds, family offices, things of that nature. And what you've been seeing is, despite this rally in GDX, the gold miners index, the share or the volume of institutional owners has been dipping down. They've been selling the rally. You look at GDXJ, same thing. You look at SIL, which is your silver miners index. Now, that's not as stark. That's not as profound as a GDX and the GDXJ. So it appears at first glance, or at least from this chart, that institutions prefer to own SIL relative to GDX, at least in the last several months. You look at SILJ, however, and more institutions have been piling into SIL than at any time on this chart since 2020
at least. That you showed, Danny,
and so what
it seems to me that the market wasn't believing the rally, or it could be profit taking, or they could be saying we don't believe that the gold indices are continuing to move up.
Well, here's where it gets interesting too. So let's take a look at GLD. GLD is the gold trust, and I believe it's the custodian is JP Morgan, correct? I could be mistaken, but I believe it's yes. The biggest gold trust out there. And as you can see, as the GLD share price rises, you don't see a commensurate amount of institutional buying on that side. But you look at PHYS, which is a Sprott physical gold trust. Now, that's been getting a load of volume coming in from institutions. So if I were to surmise what's going on, yes, much to your point, Rob, if you were just to look at the mining stocks, institutional ownership charts, you would conclude that institutions, smart money, call them whatever you'd like, does not believe the gold rally. But when you look at something like PHYS, which is a Sprott physical gold trust, that has been getting a bid, much more so than the GLD. which obviously when you see the share price move while institutional ownership stays constant or declines, that tells you that the move is being precipitated by retail buyers. So, I mean, I'm trying to figure out what exactly this means.
Well, I think I can probably tell you why that is likely. If you were, I'll tell you what, I'll share a screen and I'll just explain to you why the institutional buying isn't as well, to my simple mind anyway, why the institutional buying probably hasn't come in the way you might expect, and why that is going to be a major factor going forward.
And that's been a point. As you do that, I'll just throw in my thoughts. It's been one of the things that's befuddled some analysts is why the gold mining stocks in particular, we understand silver because silver spikes a little bit, but it hasn't had its big move the last 18 months like gold, which is more than doubled. As gold is more than doubled and the margins have blown out on the miners, why aren't the generalists coming in saying, okay, look at these profit margins. We want to jump into this because this predicts much higher share prices going in the future. We haven't seen that on this one, and it's been a bit puzzling, Kevin, because typically we would see certainly the mining stocks lag gold, but you would think that you would see more investment from the generalist sector.
Yeah, so I think the smart money is probably going to be very well aware of the gold to miner ratio and the stock market to miner ratio. This is the SIL index versus the stock market. Despite everything that's happened with the mining shares in SIL, they have not broken out versus the stock market. When it gives that signal for a breakout versus the stock market, then I suspect you're going to see a much more convincing move. And if you compare SIL to the price of silver, then again, you can see how much it's declined enormously since 2016. And what's been happening recently is just the formation of a base that we're just starting to break out from now. If you look at GDX versus gold, this is, again, telling you why the institutions probably haven't been very interested recently, the smart money, because all of this process for the last 12 years, since 2013, all it's done is it's formed a huge base. So I should probably explain to people watching this that when the chart goes up, it means the miners are outperforming gold. When the chart plunges, like it did on the left-hand side of the chart here, it means that the miners are massively underperforming gold. So the institutional money and the smart money is going to be waiting for a convincing monthly breakout for GDX versus gold. The same thing, you mentioned HUI a moment ago, and the HUI versus gold chart, which I've got on here somewhere. I'm just struggling to see.
There you have right there, XAUSD over.
Where are you? Oh, there we go. Yeah. Gold versus HUI. That's the one. So when the chart is going up, gold is outperforming the HUI index. When the chart's coming down, gold is underperforming the HUI index. Now, if I put on the moving averages, that's the 3-year moving average there I've put on. For some reason, it's not displaying the 4-year. And if I put on the Ichimoku cloud as well, what you have is a cluster of evidence. We call it an evidence cluster on the chart, where all of these support levels are in a small area. So the 3 and the 4-year moving average are here. The rising support lines are here. And the Ichimoku cloud, which is a technical indicator as well, is here. So when you're below the cloud, you're in a bear market environment. And when you're above the cloud, you're in a bull market environment. So in other words, this chart is telling us that it's in a bearish environment now, which means it's likely to carry on falling, which means that the HUI, the gold miners, are likely over time now, despite any bounces to the upside, they're likely to be entering a new period of outperformance versus gold. And that is literally only just happening now. So if this is confirmed over the next month or two, then I would expect the interest in the mining sector to gradually increase. Now, it's not going to happen overnight. It's going to be probably quite slow to get underway. But this is a paradigm shift. You know, when you break either above or below a resistance line that's been in place for decades, then I think it's fair to call it a paradigm shift. So for
why do you think SIL and SILJ have been getting more interest from institutions relative to GDX and GDXJ? Why do you think silver miners have been?
I think probably because of the well accepted view that silver is very poorly valued versus gold. So there's you pull up the gold to silver ratio, and you would see straight away that we're at a pretty high level for the gold to silver ratio. So when you go all the way back through history, you can see just how high we currently are on the gold to silver ratio. We're up here somewhere. And the technical chart pattern suggests that a breakdown is likely coming. And when a breakdown happens, that's the main event. That's when silver's going to go bonkers, as Pat would say. And I think a lot of people are probably positioning for that event, even though we've probably got a little bit of a period of time first where, it's going to be a bit sort of volatile, and silver may well have another period of underperformance if this ratio spikes to the upside in a recessionary as we enter a potential recession. So I expect volatility here, but historically speaking, you have to look at that chart and say, there's a lot of stored up potential for the chart to move down, and therefore for silver to outperform gold. And one thing I just want to remind people of when they're talking about silver is this: when will silver outperform? Okay, when will silver outperform? Look at the bottom chart there. That's the stock market. That's the S&P. Okay, and look at the drops on the S&P: 50%, 26%, roughly 50%, over 50%, over 30%. So these big drops in the S&P, when they are complete, the chart above rises rapidly. The chart above is the silver to gold ratio. So when the chart rises rapidly, silver is outperforming gold. So if you're wanting to catch one of these spikes where the chart rises and silver outperforms gold, and actually silver outperforms most things when this happens, then the time to do it is actually when the stock market has reached its bear market low. And clearly the stock market hasn't even started to break down yet. So, this is just another way of expressing the fact that we are so early. You don't feel that you've got any sort of fear of missing out on this, because even if silver goes to $60 over the next, next month or two, that's nothing compared to where silver's going to go. We're talking about, in my view, well north of $100, $150, $200 is not out of the question. If we repeat the same percentage moves that silver did in its last two big bull cycles, then over a period of probably 10, 15 years, it wouldn't be unreasonable to expect silver north of $200. And, when you're starting at the levels that we're at the moment, to some people, that just sounds absolutely crazy, but it's entirely historically probable that silver can.
I wanted
can do
to, we've added a new guest for program. Tavi Costa has joined us. Tavi, thanks for jumping on. I know you got a busy schedule. First of all, introductions to Danny and from Capital Cosm, and Kevin from Northstar Bad Charts. This is Tavi Costa from Crescat Capital, a long-term friend of the program. And you're known, Tavi, for looking at a lot of things that we just looked at. We were just talking about gold and silver relative to the stock market and the miners, like the Huey and the GDX, the GDXJ, that type of thing. This is right up your alley for types of things that you look at Crescat. Can you give us like your elevator pitch or your few-minute view of where gold and silver are in their life cycle and how that compares to the mining stocks, and why we've seen the mining stocks make the moves that we have? What's your view on that?
Well, first, thanks for having me, and my sincere apologies for the delay. I was in an urgent call that went longer than I expected, but everything is good. I think this is an interesting juncture because we're seeing in macro, in my 2 cents at least, and the way I see the world, that these things never happen all at once, and so you tend to see almost like a domino fall, although they're not falling, they're really rising. And it starts with the easiest things to understand first, that have a very simple and compelling thesis with a lot of liquidity and history to really back those views. And I'm referring to gold. Gold was the first one to start moving, and central banks purchasing. It's very easy to sort of get your arms around it. As where we are right now in this juncture is that we've seen this move already, and we've seen the very early innings of the gold move, and the next innings we're starting to see the catch up of other metals, and we're also starting to see the move towards the miners. And so the beginning was with the royalty companies, the high quality cash flowing businesses were certainly the ones that attracted capital first. Copper was the first one to also have a big move with gold. Silver started to move as well. Platinum started to move. Palladium started to move. But as you can see, the money is trickling down. In fact, since April 21st of this year, gold has essentially gone sideways. In my view, just a normal consolidation. And silver is up, double digits at the same time. And so clearly there has been some acceptance of risk naturally occurring in markets from investors. And in fact, if you look at the TSX Venture precious metal sub industry alone, that is up 30+% during the same time gold is flat. So, you don't see these things unless you're in a real bull market. And so, in my opinion, we're in an interesting juncture because gold is just starting to maybe underperform a bit some of these other more riskier parts of the industry. And I really think this is just the beginning. I'm very focused on that portion because clearly we're seeing M&A starting to really move the needle in the smaller names as well. We're starting to see first was just the mergers between those larger companies, and now it's starting to move down to the smaller names too. Engagement of the majors with companies overall, and institutional awareness of which has been, probably gone for a long time, is starting to come back. People asking questions about what's your favorite mining company, and I'm starting to hear those things, particularly coming from more smarter and larger investors that tend to come in after after a little bit of a move. And so it's extremely exciting. I think it's we're finally seeing this come to fruition, and I really think this is the long term trend alongside another one that I think it's also going to be just as important, which is emerging markets. We probably are, where we were with mining 2 to 3 years ago. We're probably in emerging markets because it's also an acceptance of risk. Emerging markets are kind of a derivative of the mining industry when it comes to, after people start to deploy capital in gold and silver, copper, platinum, palladium, royalties, seniors, juniors, they start thinking, oh, what else can I put money into? And guess what? A lot of emerging markets, particularly Latin America, have a lot of leverage relative to metal prices. And so you tend to see that move in that direction too. So it's my view that we're going to go there as well. So it's really exciting times in my opinion. And, I've been very focused on the mining space because I think that's the place to be as well.
Yeah, Tavi mentioned this recent consolidation since about April, and if you look at the charts here, let me pull it up. So if you look at the gold chart, you'll notice that the way gold's been moving up since a couple years ago is that it does have like these sideways consolidations, and then it just shoots up. So it's like a stair step almost. And what you'll also notice that this time around, we started consolidating sometime around April. And last year, we consolidated sometime around April. And we didn't really see a big breakout in the price action up until August. Now, we're in mid-August. We're past mid-August now. We haven't seen anything yet. But, wouldn't you guys say this looks more like a continuation as opposed to a topping pattern for gold? It certainly does to me.
I can sort of push back a little bit on that, I think, because comparisons with a year or so ago aren't really entirely well. Okay, let me just share a chart because a picture paints 1,000 words, and it'd be interesting to see what Tavi thinks of this as well. Okay, so let's just zoom in a little bit, and you can see a consolidation that took place back here. And consolidation back here as well in the early stages of last year, I suppose. This is the monthly time frame chart. So you can zoom in a little bit at these sort of pauses and you can see more detail, but I think you get the idea. So the question is, now that we've got to where we have, and I'm just going to mark on the breakout on the chart that I think we can probably all agree with, broadly speaking, the sort of breakout that hopefully caught everyone's attention more recently was this one. Now, from a technical chart perspective, we often look at measured moves, and we look at sort of how much you might expect from a move. And very often the energy into a consolidation is replicated by the energy on the way out. So just from a very simplistic point of view, you might start looking at that thinking, well, how much more can we expect from this? But if we just take that one stage further and look at how far gold is from its 3-year moving average, and hopefully I think a lot of people will have seen me banging on about this, that green line there is a 3-year moving average. And historically, if we just ignore the 1970s for a moment, historically, when you get this far stretched from the moving average, there and here, and here, and in fact here as well, what you get is a multi-month stalling of the gold price with a pullback of between roughly 25 and 35%. Now that would equate to somewhere around about $800 in today's terms, and so far we've only dropped about $380 on spot gold. So the question is, can we expect gold to go much higher now that it's historically stretched from its long-term moving average? And now I'm just going to slide across to the 1970s and just throw in the curveball that you're probably all thinking about. And that is, well, yes, Kevin, but in the 1970s, look how high gold stretched above its moving average. My counter to that is look at what was happening to the 3-year moving average for gold, because the gold price was pegged. The 3-year moving average for gold was completely flat for decades, and that's not the case at any point.
Yeah, so essentially what you're saying is there might have been a lot of pent-up price pressure in gold, and once the fix was removed, perhaps that what we saw was the correction of...
Yeah, a little bit like when Bitcoin hit the open market. When Bitcoin hit the open market, what did it do? It shot up by tens of thousands of %, and that kind of move has never been replicated since, and never will be, because market cap is increasing, and all the stuff that can happen to a meme stock cannot happen to Bitcoin, in the same way that all the stuff that can happen to a junior miner in terms of price cannot happen to Barrick Gold, for a whole variety of reasons. So, So, if the US revalues gold to $20,000 or something, or $10,000, then yes, of course, it's going to jump way beyond where it has done for the last sort of 40, 50 years. But I'm just trying to put in a dose of realism. If we think that the 70s is going to be replicated and there's going to be some kind of paradigm change in the way gold is valued, then yes, we can stretch to 200% above the moving average. But if that doesn't happen, then it won't. So either something is going to happen that hasn't happened in the last 50 years in the gold market, or we're just going to have a standard, or we're going to have a more serious pullback than the one that we've seen so far.
So that's good charting there and kind of seeing what the normal expectations would be for what we're seeing. Let's get into that. I'll start with you, Danny. You asked me last time, what could be a black swan in this market? I think it would be a black swan. It would be a bank failure, a very serious hot war, supply chain issues, central bank collapse, something along those lines.
Is that a black swan, though? That's more like a gray swan, isn't it?
So what would cause potentially gold to be able to have that kind of move like we saw in the 70s? Is there anything out there in your view that could do that?
I mean, easily a gold reval, but I'm not going to stake everything on that.
Yeah.
That may or may not happen. There's certainly a lot of chatter about it on YouTube, and I'm certainly contributing to it with some of the people that I have on. But be that as it may, yeah, I mean, a gold reval could do it. Just a continuation of these wars. You started to see gold and oil sell off once on this past Friday when you saw the Alaskan summit between Putin and Trump. The more dire it appears on the geopolitical stage, the greater the bid, and the less likelihood that you do see some correction on gold and oil and so forth. I mean, you can make the case that with everything going on around the world, all of these bottlenecks in the Middle East and in Eastern Europe, and oil was still at $62. That's that's pretty much a signal for weakness in the economy. I mean, despite all these geopolitical tailwinds going on, and you're still seeing oil at a fairly subdued level. It's not it's not a good story for the greater economy, so to speak. But to answer your question, I mean, there's a number of things that could set off the gold price. Gold is, people like to call it an inflation hedge, but it's really, historically, if you look at it, it's more of a crisis hedge. It's what people flock to during times of uncertainty and crisis. And that's really when it gets its big where it gets its big bids down the line. So any sort of crisis, really, another breakout of war somewhere, an intensification of war, a gold reval.
I mean, the war thing, just to sort of make a point on that. When Russia invaded Ukraine, that was when gold peaked. Gold peaked.
That's when oil peaked too, right?
Yeah, I mean, so in February 2022, gold peaked at around about $2,000, and then it fell something like $400 in the months that followed. So war per se, and the onset of war, which that very much was, watching the tanks rolling into Ukraine, and everyone's going, "Wow, gold's going to $3,000." That marked the exact top. So
well, that was because there was legitimate fears of a nuclear war happening at that time, and then once expectations were not met, fortunately, that we didn't get into a nuclear showdown with Russia, and it seemed to be fairly contained. That's when gold sold off.
Well, it sold.
But what I'm saying is that if you get like a legitimate intensification of war, obviously it's going to be a big tailwind for the metals price.
Yeah, I mean, the invasion was in February and it peaked in March. So within a month, gold sort of started plunging. There's more. It's more, to me anyway, it's more the mathematics of the economics that's driving gold and the economic cycle itself. The fact that the 10-year yield is stuck up at above 4% with debt to GDP north of whatever it is, 120%. It's more the mathematics of the situation that is, I think, driving the price of gold. The economics, if you like, the mathematics of the economy is what's driving the capital rotation process. Don't forget, gold has broken out versus, the Dow Jones, the Russell, the Wilshire. It's broken out versus, or is breaking out versus Nasdaq and the S&P. It's broken out versus money supply. It's house prices have plunged versus gold into a historic bear market. Gold has put the DXY, the relative strength of the US dollar, into a bear market. All of these things only happened in 1930, 1970, and sort of 2000 to 2002. So those were capital rotation events where gold began a huge bull era. And it's all of those were the culminations of an economic cycle and the mathematics of the economy just not adding up anymore.
Yeah, Tavi, what are your long-term thoughts on gold?
And hand in hand, I should say, hand in hand with all of that is war, of course, and hand in hand with all of that is instability. All this stuff that you see in the news headlines that all accompanies it. But
no, I'm not arguing against the mathematics behind it. All I'm saying is that if you had to, think of some sort of black swan event, some sort of event that's more so qualitative as opposed to quantitative, war is probably one of the first few things that comes to mind to acting as a launching pad for gold.
I'll give some thoughts. And if you take more of a trading, perspective and dynamic of how things work, I believe that you have this rotation that happens in commodities that is very normal. And if you apply that thought, it would maybe give more emphasis to this idea that maybe gold, the big move in gold has already been done, and we're probably in the process of seeing that rotation into some other commodity. Gold has been the flavor of the last, 16 months, maybe 24 months. And, would arguably, maybe it's time for another commodity to take the lead now. It wouldn't shock me if that happens, but I think energy has been in that room for a long time now. How long has oil been, since you guys just mentioned the peak in the Russian invasion? Oil has been consolidating since that period. And so, some of my thoughts are I think we're in a kind of a 2 to 3 year look. If you go back to the 70s as a way, we saw these sort of maybe even 4, but usually 2 to 3 year periods in the mining industry where it was incredibly strong returns, and then also a lot of volatility on the downside at the end of those. I don't think we're in the verge of that. I think we're more still at early stages of mining outperforming metals. I think we're in the early stages of people starting to feel comfortable with the mining businesses as leverage to gold prices. I do think that's the case, especially if you look at where gold, if gold just stays where it is, even if it goes lower, it goes back to 3,000 or 2,800. I don't care. I mean, most of these companies in the mining industry are still mining at substantially lower, sometimes half of the gold price, all in sustaining costs. So it is what I've been trying to name as the golden age of mining that we haven't seen in a very long time. Maybe in the 70s was something similar, because even in the early 2000s, the gold to oil ratio or the silver to oil ratio were nowhere close to where it is now. So, you do have these pretty substantial margins that I think have not attracted enough capital yet and will in the next 2 to 3 years in the mining industry. So I'm very, very focused on that portion. Now, talking about Black Swan, I think Black Swan potential, it's been, of my opinion, it would be, now I'm going to mention something, I could be wrong, and I'm honestly not trying to position myself accordingly. And so this is, take that with a grain of salt, obviously. But I think electricity collapse or some sort of major shortage of electricity could be in the cards for the next 3 years. We've seen some moments like this in Europe and recently in other cities every now and then, but I'm talking a big one, one that really causes issues over the long term. We're seeing places like Texas beginning to try to apply laws where data centers would actually take the hit if there's some sort of issue with energy demand surging and causing supply issues in cities. And I don't think we have fully understood yet what is the complete demand of these AI model and companies that are using currently relative to what we have in terms of the grid and the current infrastructure in place. And so I do think that in the next 3 years wouldn't shock me at all if we see something like we haven't seen in the past. Like, that's a black swan, right? Like, I'm talking a long-term, blackout that causes some damage on something, and that would be, to me, in the cards. Just to keep it short, I think that on the gold side, the revaluation is real. It's very, very real. I mean, I had the chance to speak with a few people that are in the policy-making realms, and it just seems like this is a real opportunity to do that. And it's not like the Treasury has a lot of options, and that's certainly an easy option to take, is to revalue gold. I think that will happen. If I had to put my money on something, I do think that has a high potential. And on top of it all, what it could hurt gold near term is 90+% probability of a rate cut with inflation accelerating and a Fed that maybe is taking a political view. Yeah, that could be a problem right here. You can see markets falling, and probability of rate cuts are very off potentially, and maybe go to zero. Imagine going to 90 to zero. I don't think gold is going to like that. But at the same time, 6 months from now, we all know what's in the cards. Trump is going to try to get majority of the governors, and no matter where inflation is, he's probably going to lower rates. And if you see that world, I don't want to be against hard assets at all. I want to be in front of that. So it's really tough. It's easy to say I'm going to buy and hold, but holding is very difficult. And a lot of moments you're just trying to sell it because you think there's a short-term peak. But look, I was involved with NVIDIA at the early stages. You can see, Crescat had a huge pitching on this back in the days in 20, not the days, but like 2013, 2012 or so. We came in with a huge, report about NVIDIA and so forth. That was kind of what Crescat, I actually got its name around initially. And from even, different opinions in the governance of even our views on in terms of how to manage portfolio and so forth, we decided to sell the shares at a really cheap. So it's, and it kills me to know that I was an early seller of that. What's my lesson is, I watch for these big trends, and I don't want to be too cute selling on a huge stake on something I really think it's going to be a very long-term trend. And so that would be my just my caution on near-term trading, because it can cost you a lot of money. It can cost you a lot of money if you're right on a big trend. And so, but whatever you do to sleep at night, to invest, to manage your own portfolio is probably what works for you. So I think that's it. That's the conclusion.
I wanted to throw in an additional thought on
just
the bear case for gold. If you think about interest rates and where that can bring gold down, technically you have some Elliott wave chart is saying we may be on a down slope if it's completing the fourth wave of Elliott. And if you tie that in with interest rates and maybe some deflation in the economy, you could see short to medium term some fade in the price of gold. Maybe it comes down a little bit below 3,000. And looking at the chart you were showing, Danny, so I'll toss it back to you, that you were showing earlier, you were looking at the current sideways move, and it was a little bit different. And it may be indicating we have a little bit longer of one to go because of these fundamental forces. But I'll throw it back to you because I know you wanted to tag on to what Tavi had said.
I just wanted to kind of pour some more gasoline to the grid down failure fire that Tavi alluded to. So if you think about like these max 7 stocks that are pretty much lifting the entire global stock market on its back, or at least the U.S. stock market, that is, if you were to have a grid down failure and you started having to sacrifice these data centers in the process as time went on, I mean, what would that do for the valuations of these max 7 stocks that are highly dependent on the AI story? If there just simply isn't the electricity to power them, all of a sudden the narrative fueling Meta, Google, etc., just goes out the window. I mean, so that would be its own like second order effect, after gold catches a bid or whatever. So there'd be a huge, I would presume there'd be a huge exodus out of these stocks.
Funny enough, you think about this from a political standpoint. I'm not a guy who believes much in, these policies for climate change. But if you think about it, I don't believe in those at all. But if you think about it, that was probably the best thing that ever happened because it brought awareness of, the fact that we try to impose those policies and, let's use electric vehicles and all these things. It brought awareness to the fact that we don't have a grid for it. And, at the end of the day, maybe that was what we needed to. And now we actually have a real reason to fix those grid issues now with AI. That, in my opinion, the difference of AI versus internet and other things is that when we had the railroad revolution or internet, it wasn't an arms race. It was just a real advancement happening, but no country was trying to get there first. In this case, it is like that. And so, construction, would I bet against construction, infrastructure spending and all that? No, I think we are in a real war time kind of thing. I mean, you can see the engagement of the government on MP materials, Intel, now, NVIDIA. Like these things are real. All these things go back to the World War II kind of era when it comes to similar policies, when we saw them betting on industries and manufacturer companies at that time as well. And so, I think this electricity shortage thing could be a real problematic thing in the near future. And I think what you brought in is a good point. But maybe those, maybe we'll decelerate this AI situation a little bit, but if you listen to Trump, I mean, can this administration afford to decelerate? Are they willing to take that view? And I don't think that's even the case. And so I don't know. I really think this could be a black swan.
Yeah, they've given indications that they're going all in on growth. So
Yes.
they've completely cut out like the fiscal conservative like mantra, like just going all in on trying to grow their way out of the sovereign debt crisis. So yeah, I mean
And it's
they've got to make
predictable
this
when you
work.
get to this phase of the system where they know if they tighten, actually the effects could be really bad. If we were to tighten right now, you could throw us into like a Great Depression potentially with the way the credit cycles work. And it's not only the United States, it's the whole world. It's like we're all in concert together. All of our system is intertwined now. So it makes more sense to me that countries are saying, well, screw it, we're going to go for resources. That's why maybe the AI race, maybe all these things is they're thinking, how do we cut costs and maybe grow past this? Because if we cut, nobody else does, it puts us at disadvantage to everybody else, but also it could crash our economy. And the second and third order effects are that in itself is going to reverberate around the system. So certainly I think the United States, China, Russia, India, all these big countries are not making decisions on their own. You have to think about trade. You have to think about dependencies on things like rare earths and energy and commodities. And it's certainly, I think, a much more complex equation than it used to be. And Kevin, we're going to end with you because we've been going for about an hour here. So we'll end with you. Final thoughts, Kevin, on what we've been talking about, anything additional that you want to leave? And after that, we'll go ahead and get this one wrapped up.
Yeah, sure. Just looking at the S&P chart, it's worth noting that the S&P versus producer prices has just broken out to the upside. If you look at the equivalent chart for the S&P, and this goes back 100 years, by the way, if you look at the equivalent chart for the S&P just priced in the US dollar, we're actually right up against this red resistance line now. So a little bit like cryptocurrencies with Bitcoin, a critical point, and Bitcoin dominance at a critical point here. A lot of the charts are sort of resting either on support or pushing against resistance. So I think the next couple of weeks are going to tell us whether this S&P chart that we've got here on the daily time frame is actually going to break out above the 64.50 level and give us a melt up to end what I think would be a pretty dramatic end to the current economic cycle, or whether we just get a rejection here and we start to break downwards. Just finishing finally on that gold miners versus gold, just to note that in the big bull market of the 1970s, the miners didn't outperform gold. Gold was the big winner in the entire 1970 to 1980 bull era. This ratio just plunged, which shows that gold was outperforming the miners. The miners actually bumped upwards versus gold in the early 1980s, which was a bit bizarre, but I suspect that, of course, the miners were massively impacted in the 70s by huge energy costs and industrial action and all that kind of stuff. These red areas highlight the gold bull eras. The green zones highlight when the miners were outperforming the metal. So during the last bull era in the early 2000s, this red zone here, the miners outperformed gold for a portion of it, but from start to finish that bull era, gold matched the miners' performance equally. This is the ASA index, by the way, which is exactly the same as GDX. It just happens to go back 50 years. And in the current bull market, which started around about 2019, we've had a little period of outperformance of the miners, and we're just starting to outperform again. But overall, we have not broken out. This resistance line is critical. So very early days for the miners versus the metal, but I also agree that the miners have a huge potential ahead of them, and it's very early in the story. A lot of it now hinges on what the S&P does over the next few days and the next few weeks, because that will determine the direction of the markets more broadly.
Thank you, Kevin, from Northstar Bad Charts. Wanted to thank all my panelists for joining. Tavi, Danny, and Kevin, thank you so much for jumping on. I feel like we just kind of got into the discussion. We could probably go for hours, so definitely I look forward to having you guys back on the program in the future. Maybe we'll kind of explore this more in depth, especially with what I think is going to be a very interesting next 3 to 4 year time period. I think if you have been waiting for certain things to happen in the gold and silver space, the mining space, and maybe opposite things to happen in the general markets, I think the next 3 to 4 years is going to be very interesting for you. And certainly we're going to continue to track it here on the Freedom Report. Thank you to everybody for joining us, and we'll see you next time.